I believe that over 10 years, the US dollar loses 75% of its purchasing power.
Yep.
If it does that, I would expect that gold would maintain its purchasing power, which means that over 10 years, I see gold in nominal terms between 3 and 4 times higher than today. In prior bull markets, once the crossover has occurred, once silver begins to outperform gold, the performance in silver is roughly double the price of gold. If one looks at history too, the higher quality silver juniors outperform the silver price 2 to 1. So if you follow that arithmetic progression, what I'm saying is that there's a possibility, if not a probability, that over 10 years, a portfolio of high quality silver juniors could give you a 20 to 1 return.
Over the past year, we've heard countless predictions about the future of the US dollar, but very few analysts explain the mechanics behind long-term currency decay as clearly as Rick Rule. In this interview, he makes a staggering projection. Over the next decade, the US dollar could lose as much as 75% of its purchasing power. If that happens, and history shows similar episodes have happened before, the implications for hard assets are enormous. In particular, the shockwaves through gold and silver markets would fundamentally reshape the investment landscape, driving a multi-year revaluation cycle unlike anything most investors have ever experienced. Rick argues that silver, not gold, will ultimately be the market's standout performer. And the logic is difficult to dismiss. When gold begins to rise steadily on fear-driven demand and eventually attracts generalist investors, market leadership almost always transitions to silver. Silver is the high-beta monetary metal, the one that overshoots, overreacts, and generates the violent upside moves that characterize every major precious metal bull market. According to Rule, once this crossover happens, the performance of silver historically doubles gold's percentage gains. And if gold rises 3 to 4 times from current levels over the next decade, the arithmetic on silver becomes explosive. But Rick doesn't stop there. He points out that the real asymmetric gains sit inside the small universe of high-quality silver juniors, companies with genuine deposits, economic grades, and real development pathways. In prior cycles, these names didn't just outperform the metal, they outperformed it 2 to 1. Layer that multiplier on top of silver's natural torque, and suddenly you're in the realm of 20 to 1 returns over a full cycle. Not hype, not speculation, simply the mathematical consequence of leverage, capital flows, and scarcity in a sector where few companies actually produce primary silver. This establishes the foundation for Rick Rule's most important point. Investors who understand where we are in this cycle, early, unloved, and still far from the mania phase, are being given a rare setup. A setup where macro deterioration, supply-demand imbalances, and institutional under-ownership intersect with real historical precedent. If Rick is right, we are in the first innings of a monetary revaluation that could turn deeply hated assets into decade-long wealth generators. And that brings us to the heart of Rick's argument: how precious metal bull markets actually begin, why leadership reliably moves from gold to silver, and why this moment looks eerily similar to prior cycles he has lived through. Let's dive into the first clip. Before we continue, make sure to like this video and subscribe. It helps us reach more investors who want to understand what's really happening beneath the surface of the precious metals market. And if you want deeper analysis, turn on notifications. We appreciate the support and hope you enjoy the video.
My experience has been that precious metals bull markets are established by gold. It's the fear buyer. And when the momentum in the gold price attracts generalist investors to the space, market leadership changes from gold to silver. This will be the 4th time in my life that this occurred. It looks like in the market that transfer is taking place as we speak. Whether or not that's true, of course, time will tell. When leadership transition does take place, silver outperforms gold pretty dramatically. And the high-quality silver stocks outperform any other extractive asset class I know. I hope you paid attention to the part where I said high quality, though.
Yeah.
There are a lot of purported silver companies that litter the speculative landscape who unfortunately have no silver. Those can uniformly be expected to do well too for a little while, but they're treacherous places to be.
Yeah, and we've always seen this with rallies, though, haven't we? Well, I'm sure we're already seeing some more silver names prop up as well. We saw it in lithium. Everyone turned into a lithium company when the price rose. So I'm sure that will be happening. But what I've heard in the past as well is that when we do see that silver price start to rally and pick up, and everyone's, your barber's talking about investing in silver stocks, that's probably a time where you should probably be more cautious. Are we there yet?
Oh, not close.
No?
No, not close. These are truly dramatic runs. And I'm not saying it has to happen. I'm just saying that 3 times before in my life it has happened. And I'm hoping at age 72 it happens to me one more time. But let me give you a couple of arithmetic stories to warm up your audience.
Okay.
I came into the business in the 1970s, the most dramatic precious metals bull market in recorded history. One little silver company, then Coeur d'Alene Mines, now Coeur, started 1970 at 10 cents and ended 1981 at $65. Now, I was too young, too dumb, too poor to pay attention. But in the little rally that we had in the first part of the decade of the 90s, I helped float 2 silver companies, one Silver Standard, the other Pan American. They went from 72 cents respectively to $45, 72 cents and 50 cents respectively, to $45 or $46 in the space of 6 short years. These are truly breathtaking moves. They are not to be done with money that you had set aside for a child's college education, but they are the kind of moves that can take mad money and turn it into real money.
Are we still fairly early on in this cycle, in your view?
I think we are. We haven't had the type of move in the silver market that would allow the senior producers' margins to increase as dramatically as the gold producers have. The strength that we've seen in the gold market for the last 18 months has a lot to do with the fact that they're making so much money. The silver guys haven't had that happen to them yet.
They must be getting close, though, don't you think?
You bet.
Because let's have a think. So most silver companies, what's their ASIC? Around $15 to $20, would it be?
Well, that's a trick question, because only about 18% of primary silver supply comes from silver mines.
Right.
82% comes from copper mines or lead mines or zinc mines. One could say, as an example with Freeport-McMoRan, that their cost to produce silver is 0. Right now, the move in the silver juniors isn't fact-based. It's moved around silver in the anticipation that the stocks will do well. For it to become real, the market is going to need to see a bang-up quarter out of Hecla, or a bang-up quarter out of Coeur, or better yet, both. A bang-up quarter out of Pan American, and they're going to see that. It's important to note that most of the real silver companies are gold companies in drag. More than half of their revenues are gold, but they're still extraordinarily leveraged to silver. It's important to note, too, that while gold is not merely at nominal all-time highs, but probably in constant dollar all-time highs, silver is far from an all-time high. $57 comparing to 50 forgets the fact that 15 years has passed since the last time they were at 50. The dollar's deteriorated.
Are you already positioned in silver?
I've got a good position. As you know from earlier interviews, I love hate.
Yeah.
In 2021 and 2022, the junior silver stocks were hated.
Yeah.
I mean, truly hated. It was very clear to me at that point in time that Vizsla was going to be a mine, and nobody wanted it. The consequence of that is I didn't just buy it; I bought a lot of it. Yeah. And so, I would suggest that in the silver names that matter to me, I've got plenty. I've become very patient and very tenacious, not because I don't wish for instant gratification, but because I've learned over 50 years in the markets that instant gratification is not on offer. An investor who is prepared to stay the trade for 5 years is by no means too late. Yeah. Let's look at the arithmetic. 2 interviews ago, not the one in Zurich, but the one before that, we talked about the fact that I believe that over 10 years, the US dollar loses 75% of its purchasing power.
Yep.
If it does that, I would expect that gold would maintain its purchasing power, which means that over 10 years, I see gold in nominal terms between 3 and 4 times higher than today. In prior bull markets, once the crossover has occurred, once silver begins to outperform gold, the performance in silver is roughly double the price of gold. I'm not saying to you that silver is going to go 8 to 1, What I am saying is that a move higher in silver, from my point of view, is statistically extremely probable. If one looks at history too, the higher quality silver juniors outperform the silver price 2-to-1. So if you follow that arithmetic progression, what I'm saying is that there's a possibility, if not a probability, that over 10 years, a portfolio of high quality silver juniors could give you a 20-to-1 return. Your investors shouldn't think in their mind, Rick Rule just said that amalgamated moose pasture silver is going to be a 20-bagger. I'm not saying that. I'm saying if you follow the arithmetic progression, that there's a very good probability that a carefully chosen portfolio of high-quality silver juniors has the potential for persistent and tenacious speculators to generate a life-changing event.
As Rule explains, most primary silver supply doesn't even come from primary silver mines. It's a byproduct of copper, zinc, and lead production. That means the real leverage, the explosive torque, sits with the tiny handful of true silver producers, those with costs in the $20 range and margins now approaching 200%. When the market finally sees 1 or 2 blockbuster quarters from the likes of Pan American, Hecla, or First Majestic, the entire sector could re-rate violently, just like we witnessed in the 1970s and the 1990s. And Rule's arithmetic matters. Silver at $50 15 years ago is not the same as silver at $50 today. Adjusted for the dollar's deterioration, $50 silver from the 1970s equates to more than $200 today. Meanwhile, gold is already carving out new all-time highs in both nominal and constant dollar terms. But silver is still nowhere close to its inflation-adjusted peak. That is exactly the kind of lag that precedes the classic catch-up phase, where silver tears upward and the juniors become volatile with a heartbeat. This is why Rule emphasizes patience. The violent phase of a metals bull market rarely announces itself. It creeps forward in margins, in positioning, in hated sectors slowly turning, and in early investors quietly accumulating the names nobody wants. When the front page of the Wall Street Journal starts talking about silver, the easy money will have already been made. According to Rule's decades of experience, we are nowhere near that stage. Let's get back to Rick Rule's interview.
If the US dollar lost 75% of its purchasing power, and the dollar maintained its purchasing power, that would suggest a 3-fold to 4-fold increase. It's simple math.
Okay, so potentially $8,000 to $12,000 gold over a 10-year period.
I would be surprised over a 10-year period if the gold price wasn't measured in 5 as opposed to 4 digits. Markets are shaped by narrative, but investment decisions should be shaped by arithmetic. So let's look at 3 different pieces of math. The last period of major dollar instability in my lifetime was the decade of the 70s. The US dollar again lost 75% of its purchasing power, and gold went up 28-fold. If you had told most people, myself included in 1970, that gold was going to go to $800 from $35, I would have accused you of smoking a then illegal substance.
Right.
You know? The second piece of arithmetic is simply that number, the deterioration of the US dollar. We covered in a prior interview the debt owed by the US government and the ability or the inability to service that debt. The inevitability that they inflate away
They have to.
their unfunded liabilities. So, those are 2 important pieces of math. The third piece of math is this. While gold is performed in a way that you and I understand, most of the investment community still can't spell gold, despite the fact that it's a 4-letter word. It is very, 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 very under-owned.
Have you and do you care about lithium at the moment?
I don't.
You don't?
I think that maximum hate in lithium will occur in 2027 or 2028.
Okay.
The little increase that we've seen in the lithium price has given hope to the lithium market.
Yes.
And the market has to be hopeless for it to be hated.
Okay.
There's arithmetic around lithium, too. Most people think we had a lithium shortage, and that's why the price went up. That's wrong. We had a shortage of lithium processing capacity. In that so-called shortage, both Albemarle and SQM had 80 or 85 years of reserves. There wasn't a shortage of elemental lithium. When the price went up, people piled into the lithium market looking for lithium, and they found a lot. Probably 150 deposits. Maybe 5 are viable. So the investors in the other 145 have 2 more years to learn hate. I think we've done a very good job of debottlenecking the lithium supply chain to the extent that treatment charges are falling fairly quickly. What will happen, I think, 2 years from now is that, first of all, the investment community won't segregate between 145 large projects and 5 lousy projects and 5 good ones. That's what hate does. People hate lithium, so they don't segregate between good projects and bad projects. And you'll be able to buy the good projects at a bad project discount.
Yeah, well, we're seeing that with nickel right now, though, aren't we? I mean,
Absolutely.
It's
Absolutely.
incredible.
When that happens, with one caveat, if the technology around direct lithium extraction doesn't work or doesn't work well, then you're going to have a great game. I mean, a truly great game. You will have, as we had in uranium, as we had in silver, you will have $2 billion net present value deposits selling for 50 or 60 or $100 million.
Rick Rule's framework is brutally simple. If the dollar continues down a trajectory similar to the last major period of monetary instability, gold is statistically positioned to reprice by multiples, not percentages. And if gold multiplies, silver historically doubles gold's performance. Then the high-quality juniors historically double silver. Whether investors like the math or not, the arithmetic is the arithmetic. And Rule has lived long enough to see how these cycles behave when narratives finally collide with reality. We're already seeing the early signs: gold carving out all-time highs, Western institutions still severely underweight precious metals, and supply chains across the mining sector tightening. Yet silver remains drastically undervalued relative to both history and fundamentals. In past cycles, these conditions marked the phase just before the public rush, before the parabolic stage where tiny companies transform into household names and disciplined investors turn asymmetric bets into generational returns. And Rule's point about the most hated sectors, uranium, nickel, lithium, should not be ignored. He has built his career buying what the crowd despises, waiting for the math to overpower the mood, and then letting the cycle do the heavy lifting. Silver, as he makes abundantly clear, still sits in that unloved category. Its breakout has barely begun. For those with discipline and a timeline longer than a single market headline, Rule is arguing that the next 10 years could mirror the most explosive episodes in precious metals history. In his view, this is not about speculation for speculation's sake. It's about understanding the inevitability of monetary cycles, the brutality of inflation math, and the extraordinary leverage embedded in a sector still ignored by most mainstream capital. If the dollar loses another 75% of its purchasing power, as it has before, the idea of gold at $8,000 to $12,000 and silver multiples above that is not radical. It's arithmetic. If Rick Rule's 50 years in the markets teach anything, it's this: the biggest moves happen long before the public realizes what's coming. Gold is signaling strength, silver is historically underpriced, and the juniors, the real ones, remain in the accumulation phase. If you want deeper analysis like this, full breakdowns of major interviews, and early access to market research before the mainstream catches up, make sure you subscribe, hit the like button, and turn on notifications. Thanks for watching.